Hello my fellow freedom builders and welcome back to the channel. Today we're going to talk about dividend investing in a bear market, which is a topic that I get quite a lot of questions about. So let's dive right into it and let's see what it's all about. Before we start, if you haven't subscribed to the channel, please do so. We are getting a lot of new subscribers. We are approaching 2,000 and we only started in November here, so that is quite amazing. So please help us spread the word about the channel and like and subscribe and all that, so we are getting a larger audience. But let's look at dividend investing. As you might know, dividend investing has been the big thing for the last couple of years. All YouTube channels have been about dividend investing, and you can follow a lot of portfolios out there, and I think that is great. I think it is motivating to see all of these small and mid-size investors showing their portfolio, what it actually contains, what are the struggles and the successes they are seeing in their everyday investing. However, some of them, at least some of the less experienced investors, are facing some struggles right now. Because as you know, the market has been tanking. This is the Dow Jones, but we could have picked just about every single index in the world. It would have looked something like this. And the question is, of course, and the problem for a dividend investor is that I am investing for the long term. If you are a dividend investor, you are investing for the long term, hopefully, and you are aiming to pick up these good dividends that come out every month or every quarter or every year. It's different from company to company. But now you can see that your portfolio is pretty much decimated or cut down by a third. And now the question is, should I care? Should I just be ice cold and just keep investing? That is one idea. Or should I take some stocks off, or how should I go about it? First of all, the questions I'm getting about what should I do with my portfolio now that it has all dropped so much shows me that many of the investors are not having a very specific plan, because then they would know what to do. For instance, if you're a dividend investor saying, I only want stocks with that has been increasing the dividends for at least 10 years. Well, if you have stocks in your portfolios and they keep increasing their dividends, well, then you shouldn't sell it. Not even if it is cut down by a third. Because if you're in it for the long run, 10 or 20 or 30 years, and you own good quality stocks, well, the chance is that they will come back. However, I do have some concerns about this market we're in right now, and that is the concerns I'm going to address today. Because a lot of people are asking me, is this the bottom and so on? I have no idea. I have a feeling that we could go further down. And one of the reasons, and I'll show you that now because it's also a part of what I'm going to talk about today, is that I am tracking, and I know this can sound very cynical, but I am tracking the number of deaths in the United States over this illness that is right now spreading all over the world. And the reason I'm doing that is that right now, I think the largest risk for the overall economy in the world is that the US economy will be shut down. It might be the reasonable thing to do, but for the economy, it would be terribly tough. Now, as you can see here, we have the number of deaths, and this is per day. So 1 died this day and 3 this day. Then all of a sudden, at the 15th, we had 11. And then we went at 1, 2, 3, 4, 5, 6, 7 days later. That number had gone up by a factor of 10, so it was above 100. And right now it is rising. You don't have to look at this. These are just the numbers for today. But right now, this number of new deaths per day is actually going up with 30-40% per day, meaning that we'll probably reach 1,000 deaths all over United States today. That is terrible, but I am afraid that the numbers, if they're keeping this pace, could be 10,000 here and 100,000 here. And we are talking just in the first third of April. And if that happens, I think we will see a United States shutting down completely. And that, of course, will have terrible consequences for the economy, both in United States, but also in the entire world. Now, what are the consequences? That is tough for someone like me to estimate, because I am not an economist. I don't have a degree in some sort of fancy economics, so I'm listening to the guys that has it. And when I look at these, a couple of weeks ago, I saw a report from Goldman Sachs stating that they expected an overall GDP growth here for 2020 for the world to be plus 2%. And I simply could not figure out how they came to that number, because with all the shutting down of countries right now, I could not see the GDP worldwide be positive. And it was only a few days later where Goldman Sachs went out and saying, well, it might not be so good after all. We actually estimate the quarterly GDP for the United States to be minus 24%. Now, if that happens, that would be devastating. And I know that looking at the news from the United States, I can see that Trump is talking about opening up the country again just before Easter. Not the United States actually were ever shut down. There are a few states where the governors have done it, but overall the entire United States haven't been anywhere close to being shut down. So Goldman Sachs are estimating that we will see a downturn in the GDP of 24%. I haven't looked into the specifics in the history, but I am pretty sure that would be the worst case we have seen since something like 1929 or something like that. And then, of course, the competing bank, Morgan Stanley, went out. They had to top that. So they saw a 30% GDP drop. And as I said, joins Goldman Sachs in upping estimates of this economic pain due to the illness. So this is actually really, really bad. And I know that the bankers are talking about that this could get up in speed again quickly, and it might. But I must say that if we see the numbers from my spreadsheet, if they are just half right, then we will see some numbers. I just have extrapolated the numbers here. These are the numbers of deaths in 28 days, and I am perfectly aware of that. A million things can happen between now and 28 days. We could see a cure, we could see a treatment, we could see a vaccine, we could see a million different things could happen. What worries me is that the average growth per day is actually going up quite fast in the United States, meaning that they haven't even stabilized the curve yet. So I am very, very worried that we are going to see somewhere between these two numbers at least within the next 2 or 3 weeks. And that would mean, I think, a complete halt in the economy. So what does all of this macroeconomic talk have to do with dividends? Well, it does have quite a lot to do with it, because what we are starting to see is that we have large companies with dividend programs that are suspending the dividends. For instance, we have Ford Motor Company that has cut the dividends. They were paying out something like 60 cents, I think, with 15 cents per quarter. Over the year, and they have completely put that to a halt simply because they say we are not sure what the future will bring. It is simply so chaotic, the situation right now. They also put back their guidance for the year because they said the estimates that we have built this guidance on are no longer there, and they are not sure about the future, so they are simply choosing to keep the dividend inside the company to make sure that they have a bit more of a buffer if things goes as bad as these bankers are saying. So Ford have been cutting the dividends. Several other companies have been talking about it. We see the banks. Let's just see. We have the banks mentioned here somewhere. Here. Big US banks face pressure to announce dividend cuts. Now, what they have done is that, let me just show you here. They have been, the big banks may cut dividends for political rather than financial reasons, as a growing chorus of lawmakers, former regulators and consumers advocate say that it is inappropriate for them to tap emergency funding programs while paying out cash to shareholders. Now, they have been cutting down their stock repurchase program, which is quote unquote bad enough for the shareholders, because the repurchase of stocks, these programs are something that is keeping the stock price up. And they characterize this, would you believe it? Let me just see here. Yes, here it is. They characterized it as a patriotic move that would allow them to put more capital towards lending to individuals and businesses during this outbreak. Would you know that the US banks are actually doing a patriotic move right now? Who would have known? Well, I can tell you something. They are cutting their stock buyback programs, but it is not for a patriotic move. This is trying to ease the situation a bit, and they are hoping not that they don't have to cut their dividend programs as well. Because what could happen, and now we are talking a bit the broader picture here, because of the oil price war, then the oil sector is in dire need for some money, some bailouts. And many of these big banks have financed the shale oil sector for a large number of years here, and they have done that with some junk bonds, and these junk bonds are to be refinanced, a lot of them this year, and that means that the entire sector here, the shale gas sector, might need a bailout if the oil price are kept as low as it is now. And that would actually also result in many of the banks being in big trouble, because they are the ones that have lent money to this gas and oil industry. So what might happen, what I think happens, is that right now they are trying some political spin game, trying to show that they have done something, a patriotic move here. But what they might actually need to do on a later basis is to cut their dividends, because if they are going to have some sort of bailout, and that goes for all industries, if they're going to have a big $1 billion bailout or $1 trillion bailout from the government, it would be a very bad sign to the public if they were also paying out dividends at the same time to the shareholders. So they are just taking money in from the bailout and paying a big chunk of it onto the shareholders, not keeping it in the company. So what I think we're going to see now is that more and more companies in this really strange, really dire situation, they are either cutting their dividends voluntarily because they are long-term sighted, and they are saying that it is a well-led company, saying that we actually want to have some cash because we're not sure how deep this downturn is going to be and for how long it's going to be. Some of the banks are talking about that we are going to have a boost in the economy in the Q3. I simply don't see that happen. But then again, I'm not a highly trained banker, so they might be right. I have a hard time seeing that, to be honest. But it might happen. But anyway, what I think is that the clever companies, they are actually cutting their dividends to make sure that they have money enough to run the business. That is why they're there. They're actually not there to pay dividends to the investors, although we do like getting these dividends. But then again, there are other companies that will be forced to do this. That could be airline companies, several oil companies. I saw just the other day that Chevron, they have been paying dividends for something like 100 years. And I think the last, is it since 1984 or something like that, they have been raising their dividends every single year, or 1994 or something like that. I think they are one of these dividend aristocrats, actually, that I talked about in an earlier video. And what they're saying is, there was this interview, I can drop you a link, it is from Fox Business, And what the CEO of Chevron said, that they were committed to protecting dividends. And he goes on about saying how Chevron is a fantastic company. They have a lot of money. They only see this this dip in oil price, I think he calls it. I would more call it a collapse in oil prices. But he sees this dip in oil prices as a temporary thing. And I'm not sure, or actually I'm pretty sure that he knows the situation. He knows how extremely tough the situation is going to be. Russia is not getting anywhere near to getting in on the terms of the OPEC and OPEC plus. Saudi Arabia, they said, well, then we'll flood the market with oil. But actually they can't right now because they're not buyers enough for the oil due to the complete shutdown in the economy. So the oil sector is really, really going to take a hit. And I'm pretty sure he knows that, but he tries to spin it as this is just a little temporary blip, and we are committed to protecting dividends. And I saw in a thread the other day, a Facebook thread, that a guy said a link to this article and said, this is good news for dividend investors. And now my question is it really? Because what I would want if I invested in a company like Chevron, let's just put it up here. We have CVX, Chevron Corporation here. What I would think is that if I had invested in Chevron and been there for a while and been picking up some okay dividends, then I've seen the company cut in half here. And right now, with the current dividends, if you're buying down here, it would take you something like, I don't know, 5 or 6 years to slowly, no, it would actually be more like the double, 10 years or so to grind back to the price up here. If you have bought up here with the dividends up here, of course, your yield would be a lot lower. Right now, you can get it at a higher yield because the price has dropped. But would we buy this right now? If we're looking at the Stockopedia here, we can see we have the Chevron company. It is a huge company, a market cap of 150 billion euro here. It's no secret that they have dropped here. Earnings per share growth. These are the estimates, but these estimates, I'm pretty sure, have not been adjusted for the situation we are in, because I am not sure that the earnings per share is going to grow 144% in this market environment. I'm pretty sure it's not. And as you can see, the earnings per share here has been quite volatile, ups and downs all of the time, with some very big drops in the earnings per share. We can see that the operating cash flow and free cash flow has gone a bit up, but it is a bit going up and down all the time. The dividends are they're going up quite steadily here. But as you can see down here, and that's one of the things I'm looking at when I'm looking at dividends, is what is the dividend cover? Meaning, how many times can the earnings per share pay the dividends? So how large a chunk of their earnings are spent on dividends. And when the dividend cover is 2.4, it means that the earnings per share is 2.4 times the dividend. So there is plenty of room to pay dividends and then to keep investing in the company. But here we can see that it is below 1, meaning that they're paying more out in dividends than they are actually making. The same here. The same here. Then in 18, they made a bit more than they paid out in dividend, but again in 19 it dropped dramatically. And what they do have in their estimates here is that it is going to be above 1 at some time. But again, that is the estimate where we are not taking this complete shutdown of the economy into the calculation. So yes, they might have some working capital here, which actually also dropped quite significantly. So they do have some working capital and they do have some cash in the bank. But to say that they are doing the dividend investors a favor by keep paying out dividends, well, that is, in my opinion, a very, very short-term view on the situation. when I invest in a company, I am not a pure dividend investor, and I know some people are, and that is okay. That can be a great strategy. I made a video about the dividend aristocrats, and that can be a great strategy. The problem is, of course, that if you run into a crisis like this, where you see complete industries completely disrupted, where you might see that the oil industry in United States, worst case, are cut in half and never gets back on its feet. Or you might see chains of hotels, or you might see amusement park companies, or you might see a lot of companies that are simply decimated and run into the ground. And when you're looking purely at the dividends, you simply miss a big part of the picture. And I know many of you out there are experienced dividend investors, so you are looking at the dividend cover and the free cash flow, and you're looking at the prospects of the company and so on and so forth. But I can just see that a lot of people in these Facebook chats that might be pretty new to dividend investing, and they have bought into this maybe this FIRE lifestyle with financial independence, retire early. And one of the ways they want to retire early is by getting a lot of dividend payouts. The problem is that if they are putting their money, let's say that Chevron was one of the companies that they put their money in here at about 120. And that was a fair, they might have gotten something like 3 or 4% in dividend at this point. Then the company's cut in half, and they might even have to cut their dividends as well. Let's say that Chevron also have to eliminate their entire dividend program. I don't know if they will that. They say they're not, but let's see where this crisis takes us. But they might cut the dividends in half, or the dividends might disappear. And then the dividend investor is left with a company that just a few years ago were set to be it should be the backbone of every dividend portfolio, and so on and so on. And now you're sitting with a 50% haircut, and no way in the world you're going to make that back with your dividends, because you might not even get any dividends anymore. So what I'm saying here is that I'm not saying that you should completely stop investing for dividends. That would be a mistake, because dividends can be great. But you need to do a bit more due diligence than just looking at a random YouTube channel. It could be mine or anyone's. But I know a lot of these people, they're getting their trading ideas from Facebook, from YouTube. I can see it in many of the big stock Facebook groups I'm in, some of them where I'm moderating, where 20 times a day someone asks, is now the time to buy Boeing? Is now the time to buy Chevron? Is now the time to... and you should simply educate yourself, so that you are not just getting your trading ideas, your investing ideas from some random dude on Facebook or YouTube. You should definitely not just get your investment ideas from me, because I'm not a financial advisor. You can get inspiration, but you need to educate yourself so that you know that you should not just focus at the dividends. Because in my opinion, and that is just an opinion, and I'm not a fortune teller, so I have no way of saying if this is true. But if my calculations are true, just partially true here, then United States, and of course the world, because we are so dependent on the United States economy, and we also shutting down in Europe, of course, we are going to see a more or less complete stop in economic activity. We saw from China year over year, we saw a drop on 20.5% in retail sales. 20.5% did the shops sell less. Well, imagine if all of the United States were pretty much shut down and told to stay inside for the next 14 days. Of course, there would be companies that are selling online and so on. That would be a good investment strategy, maybe, to look for these. But there would be so many of the companies that you are looking at as the sure thing, that the good solid dividend, 3%, 4%, 2% per year, but steadily growing, and I just need to do this for the next 30 years. There will be some of these companies that simply don't exist in, let's say, a year. I know that the United States are getting out with bailout programs, and the Fed just promised to put $125 billion per day into a QE program. I remember the QE3 some years ago, that was, I think, just above $80 billion per month. Now they are buying up debt at a rate of $125 billion per day. They are putting a bailout or an economic rescue package at a couple of $1 trillion, just came out here tonight. And well, overall, they're just printing money. But there will still be businesses that simply cannot be sustained if there's no demand for the service. So I am quite worried, and it's not because I want to sound like some sort of perma-bear doomsday preacher here. Not at all. What I'm saying is that you should know what you're investing in, and you should have a plan. And if you are a long-term investor investing for dividends, then you should also have a plan for when should I get out. Should I get out the second they start to lower their dividends? That could be a plan. What you cannot do is just to say, I'm a dividend investor, so I'm buying this great company, Chevron or whatever company it could be, and then things really tanks, the market drops by 30 or 50% and the dividend disappears. Then you can simply not just sit and hold. That is not called buy and hold, that is called buy and hope. Because there will be a ton of your investments that simply are never even going to get back and break even. So right now, when people ask me, what do you suggest we do? I actually suggest that they start to buy some very, very broad market ETFs. Simply because that I'm not sure where the bottom is, but we are probably closer to the bottom that we used to be. I think we are more than half the way down. Maybe we have already seen the bottom right now. So buy some big ETFs. If you are a very focused dividend investors, then of course there are the ETF called NOBL Pro Shares. They have this Dividend Aristocrats, and they have also taken a severe beating here. If you have been into this here in 2020, you just started here in January, you would be down 28%. That's just about the same as the overall market. So let's see how the Dividend Aristocrats are coming up. But what I would do is that I would try to diversify. I would try to spread out on a big number of companies. It could be these aristocrats. It could also be an even wider ETF that is covering the entire world, maybe 1,000 companies. Because what I simply cannot is that I cannot guess. I cannot see through this chaos and guess which companies are going to double and which are going to be put to the ground. So what I suggest that people do at this point in time, if they have money and they want to invest, is that they cut it up in some parts, maybe 2 or 3 or 4 parts, and then they slowly put them into the markets over some months. Because I think we are going to see some sort of bottom forming. Could be that we should down 20% more, nobody knows. But I think we're going to go through a rough time. This is not over yet. So I would not suggest you just pump all your money into the market right now, but more that you do it gradually over time. Then if you are a dividend investor, you could use a dividend focused ETF. But I would not recommend you, at least if you are a beginner or you are a medium experienced investor, I would not suggest that you start guessing who of the dividend companies are going to keep their dividends running. I know the banks are saying that they will do it and they have been patriotic already, but I'm not sure if they're going to need some sort of bailout that they can justify keep paying the dividend. So we are going to get through some rough times here. The market will survive. The market will be up in 5 or 10 years. You will still be making a profit. But some of you picking single dividend stocks will still, after 10 years, be able to sit with the loss even though the market has doubled. So be careful out there. Watch out for your money. This is not this is not a free lunch. It has been for almost 10 years. It has been almost impossible not to make money for the last 10 years. And just remember that every time you get a yield, an interest of your money, that is significantly larger than the risk-free interest in society, which is right now around 0%. If, for instance, you were making 30% last year on your money because you were following the market, well, then you were taking a risk. And you have been taking a risk for the last 10 years where everything has been gloomy and fantastic. What we are doing right now is that we are paying the risk premium for that risk we have been taking for the last 10 years. And some people tend to forget that there is an over-normal risk put into the market when we are going for these sorts of returns. So right now we are paying the risk premium, and that is tough, especially because it has come so quickly. So be careful out there, really, really careful, and diversify, try to get slowly into the market, and first of all, have a plan so you know what to buy, when to buy it, and especially what should be the criteria for you to sell. That's all for now. I hope that both dividend investors and non-dividend investors got a bit of information here you could use. And I sincerely hope that we will soon find a solution to this really bad situation the world is sitting in right now. I hope for science to solve the problems very quickly. If you haven't done already, subscribe to the channel, tell all your friends about it, share it on different Facebook groups. Let's get the word out there if you think this is worth sharing. That's all for now. Thanks for your time, and I'll talk to you again soon. Bye for now.